Hello and welcome to a fresh new edition of Taking Stock, the show that we take stock of the week which has gone by and, of course, try and prepare you for the week which is coming up in front of us. It's been a good week, especially if you focus on the mid and the small cap part of the market. For the second week running, things have been looking very, very good. I am Prashant Nair. With me, my colleague Surabhi Upadhyay. Hi, Surabhi.
Hi, Prashant. Well, the kind of news that the market has had to digest, the nation has had to digest this week. I guess all things being equal, it's not been a bad week at all, perhaps one would say. So let's just quickly get to this and recap what we saw in the last 5 trading sessions. First and foremost, there's green on the screen and a feel-good factor, not just because of the small sort of win that India managed to score on the geopolitical front, but also because within the market, finally, there was the resumption of some sort of interest in mid-caps, some sign of life coming back in that side of the market, and that'll show up in the numbers. So let's quickly pull up the data. So if you're talking about the Nifty for this week, the index is up about 0.6, 0.7%. The mid-cap index is up 2.5%. The small-cap index is up almost 3.5%. And I'll come to the stocks in just a bit. But a couple of factors that really played out. And the market managed to show resilience despite what was an absolute outlier event. The entire sort of ongoings at the border was absolutely not factored in, but there was no sign of breakdown. In fact, the market kept building and is now once again knocking at the doorsteps of 10,900. That's point number one. Point number two, crude oil prices have continued to be range-bound, 66, 67. But again, that's something that the market managed to digest this week. Point number three, and perhaps that explains the first two, is the resumption of FII buying in the market. We were net positive on the provisional data all throughout the course of this week, and that buy number continues from February. February has been a net buy, and the trends seem at least optimistic for the month of March as we are starting it out as well. Let's quickly come down to some of the stocks then and recap the action, and I'll start with mid-caps to illustrate the larger point. I mean, some of these stocks have been absolutely pulverized, and they were the ones that were coming back on the forefront. Motherson Sumi, CG Power, Arvind, the rebound on stocks like Z Entertainment and Dish TV, all of that continued during the course of this week. Names like V-Guard, etc. There were plenty of takers. If you're looking out for a sector per se, then sugar was a very, very sweet spot to be in. Smart gains, 20-25% on sugar stocks across the board. Balrampur, Dhampur, ethanol plays like Praj, etc. Coming to the large caps, as I said, Z is something to take note of because here the gains continue. This breathtaking V-shaped recovery on the stock. It's now closer to the 480 mark once again. Coal India, IOC, some of the PSUs are getting very active as we enter dividend season. Some of these stocks were also finding takers. Cement is a talking point again in the market. We'll discuss that with the guest on the show. So Ultratech was one of the big winners on the Nifty. Yes Bank, where there's a new man finally at the helm, and UPL. So all things put together, this is just an example of the stock action. But I think finally, there's a sense of relief on the street, at least for now, Prashant.
Absolutely. And, you mentioned the mid-cap and small-cap returns for the week, but this is what they look like from the lows, the recent lows, which is, 2 weeks or so, right? The mid-cap index is up 5.5%. The small-cap index now is up almost 8%. So the gains have been put on pretty quickly. But it's still a small recovery when you look at the magnitude of the fall. And we're talking about indices. If you look at stocks, and I put this data up on last Friday, 50-55% of all traded stocks in the market are down over 40%, and we kind of sort of put that detail out, and it showed the damage which the broader market has seen, but some recovery nevertheless. In terms of news flow, there isn't that much, right? There's not that much to go on for the market per se. So what we're looking at today, this week, is cues from global markets, and the S&P 500, I think, is something which could provide us some direction. Not probably in a positive way. So technically speaking, there has been, what is called a negative triple divergence. So you basically have registered, 3 highs as far as price is concerned, but 3 sort of lows as far as momentum is concerned. So this has worked on the S&P 500 the last couple of times where we've seen these price corrections, and I'm talking about the last 1 year, the last 12 months this has happened, and we've seen that once again now, and this is on the daily chart. So while the broader uptrend may be intact, it might just be the case that we start to get into a bit of a corrective phase. Will that have an impact here in India? We'll need to watch and wait for that. The other sort of negative cue is flows. The monthly average in 2018 was 11,000 crores. I'm talking about money which came into domestic mutual funds. 11,000 crores came on a monthly basis in 2018. January data showed us that only 6,000 crores came in, and next week we'll get the number for the month of Feb, and by all accounts that number is almost close to 1/3 probably. It was tracking at that rate last week, so we'll see what the number is, but it certainly is lower than Jan, and a far cry from what we've seen every month coming in the month of Jan in the year 2018. And also, I think the election noise will start to go up. Monday is a market holiday, but I think expectation is that next week the Election Commission will put out the dates and the detailed schedule for general elections. So once that is out, I mean, I think politics in a way will take over. It's already taken over, but I think it'll be a big talking point next week.
Okay, well, those are lots of factors to contend with. Let's straight away get to our guest on the show, and joining in to discuss a lot of these cues is Aditya Narain, Head of Research, Institutional Equities at Edelweiss. Aditya, always a pleasure to have you in the studios. Now, I was almost going to ask you, it's a 3-day weekend. Midcaps have done so well. Do we start popping the champagne? That's on a lighter note. Yeah. But then Prashant has already tempered that with other questions. I mean, there are elections, and we don't know how this plays out. But your thoughts on the fact that at least there's some sign of life in the broader market now?
No, I think there was just too much divergence that was beginning to happen. And I think at some level you needed a certain amount of closing off that gap, right? In addition, I mean, it's interesting that you had so much action in the last week and the markets have held up almost indifferent to what would have been seen conventionally as big geopolitical risk. I think that sets the tone that there is a little bit more risk appetite than you've actually seen over some period of time.
Okay. The question is that, this interest that's come back, is it primarily flows driven because we've had positive FPI numbers coming back in? What is the sense when you're speaking to a lot of the institutional clients? What do they say now? Do they have the risk appetite returning?
I think what is very interesting is that you've had actually foreign flows come in at a point in time when you actually had, some top-down risks that have played through in the market. Yes. So I think that's very, very interesting. It's very different from what you've seen in the past, because whenever such events have actually happened, it's foreign money that has tended to go out. And in the last couple of years, it's been domestic money that has effectively stepped in. This time, actually, the reverse has tended to happen. So I think that in itself is quite interesting. Whether it is foreign flows that have gone to the bottom of the market is difficult to make a call at this point in time. But do remember that emerging markets have done very well in YTD. And India has actually completely missed that rally. So it is possible that some of that risk that people have stayed away from in India, they're now trying to actually pile back into areas that are traditionally seen or have more recently been seen as more risky. So that's how I would try and kind of look at it. But I'd say clearly the fact that India has lagged emerging markets for a period of time now, that's playing through in this.
So just look at, you said reallocation, right? But as of this, I mean, you take India and China, we got that MSCI news. People are starting to ask the question, is China starting to return both in terms of markets and economy? In terms of just allocation, I think people have still been pretty overweight India as compared to a big market like China, right? So does that argument really work when you say India's underperformed emerging markets in terms of price or allocation?
I think there are two parts to it. India's weightage at the moment would just be at average or slightly overweight. This is very different from what it was 3 months back and clearly a year back. So I think at the margin that has come off quite substantially. China tends to be more cyclical, and it has actually very divided views. There are China believers, there are China guys who buy the valuations as they get attractive, but there are a lot of people who stay completely away from China. So I think that tends to be more cyclical. India tends to be more structural in terms of how people actually want to play that market, right? So we actually had a conference very recently, and it's not as if anyone's been really very bullish on India, but the numbers in terms of people coming in stayed very, very high. So I think people are always engaged with India. I think this relative move where India has lagged has probably caught people's eyes. But the reality is that they've gone to the bottom end of the market is a little surprising.
What about flows locally speaking? I mean, there is this talk about SIPs, new registrations dropping off. The numbers I just put out, does it make you a little worried?
I think the fact that the SIPs are still holding out, I think that speaks volumes for the market at this point in time, right? I think that brings in a fair amount of comfort. The fact that the more discretionary bit has been moving up and down and has of late moved down much more, I think that is a more volatile bit of it. I don't think one needs to worry too much about it because that can come back as quickly as it's gone out. If you start seeing the SIP numbers start to tail off, already new registrations are flagging, I think that starts becoming more of an issue, not in the risk that it poses to the market immediately, but in terms of the lack of upside risk that you have in the market later, because these things take time to build up. Once they start, going over, then they actually go off for a fairly long time. So I think that's the whole thing. They are much, much more sticky, but when they turn, then that turn lasts a much longer period of time. So I think the risk to domestic money is not so much on the downside, but the lack of an upside the next time you're in a setup to move up.
I guess the counter that a lot of the mutual fund bosses will give is that SIP money is still sticky. And the moment the market starts doing well, generally the sense come back, the sentiment comes back very, very quickly. We'll watch out for those numbers, of course. But I also want to talk to you about a couple of the hot sectors now in the market, starting with autos, because that's the biggest debate point. Numbers are trickling in, the auto sales numbers. Maruti was a bit of a disappointment. Bajaj Auto more or less in line. The question is, do you start buying these stocks now, or do you think this is going to be a little more protracted, so therefore stay away?
I would actually hold back and stay away. My view is I think some of these cycles end up being a lot longer than what they've historically tended to be. And everyone is looking for that dip, when it is the market. I mean, people have been calling a mid and small cap rally for months, right? But it's just gone on to be more extended. I think the same thing filters down to real demand also. When it moves down for a little longer than what people keep hoping for, or at least the markets keep hoping for. So I wouldn't hurry into the discretionary space.
Okay.
Has that money that you're talking about, I mean, it just it makes you a bit wary that flows have gone into the mid and small cap, the bottom end of the market. Is that really true? I mean, is that what FIs have been, that money's gone there? Or this is just a dead cat bounce led by some
I mean, I wouldn't call it necessarily a dead cat bounce. I'd be some kind of mean reversal. But I don't think there'd be too much money that has gone down there. I think you don't need that much money to move mid caps.
Correct. So then,
I don't think there's been, as I said, I think risk appetite from offshore has clearly expanded because you come in a period of risk. Some of it might have gone a little lower, but most of it having gone at the lowest end, I'd be really surprised.
Oh, is this money that's perhaps beginning to build in positions ahead of the big event in the run-up to May? I mean, based on certain assumptions over there.
See, I'll tell you, the challenge with India is that the better stocks or the traditionally more sought-after stocks still remain expensive. So if you want to get India on the cheap, you have to go a little bit lower. Again, I don't think there is that kind of risk appetite for people to go very aggressively into the space to start with. Secondly, even as you go mid-cap and small-cap, it's not as if these things are very cheap in absolute terms. See, they look attractive because they've come out 20% or 40% or 50%. But it's not as if you're getting a lot of businesses at 5 times or 7 times or 10 times. You're still paying 12 times, 15 times, 18 times, which are attractive relative to where they were. But in absolute terms, they're not necessarily screaming at you.
Okay.
What do you like, Aditya?
See, our entire premise is that you still need to be a little watchful in this space over the next couple of months. I think there is a reasonable amount of risk that lies from a top-down perspective. Business cycles are improving, but they're improving only modestly, and valuations are reasonably high. So from our perspective, it is actually much more of a defensive approach that we have. So we like a few in the consumer space, we like a few in the pharma space, we like quite a few in the IT space. But by and large, we are staying top end, and we are staying more defensive sectors.
Okay, fair enough. What about the take on the cyclical recovery? I mean, we had the GDP numbers also come out this week, quite disappointing and pointing to a general slowdown. So cyclicals off your list?
Cyclicals are typically off our list, X of the banks which run a different form of cyclicality. In reasonable measure, because we don't think risk appetite is going to come back into operating businesses or lending businesses in a hurry. Right? I think it's when you have risk appetite coming back very rapidly when you can expect very, very strong pieces of rallies. You can have stuff come in from a global perspective, but those are very hard to call. But bottom up, domestically, our view is that India is more structural than it is cyclical, and the market keeps looking for cyclical responses, both in business, in earnings, and finally in terms of stocks also. And I think to that extent, some of the disappointments you've seen over the recent past is really this, that you've not seen these expectations of earnings coming back, capex coming back, are being seen in a very narrow time frame. The time frame that they actually require to come back, that time frame is longer.
Ajit, just one last question, because many would be wondering whether this mid and small cap one should venture and wade into. Some of them are arguably deep value names there, now cheaper as well. If one has the time frame, can one look at buying some of them, or is it's possible that they remain right there cheap for very long periods of time?
I think if you have a reasonable time frame, this is a good time to shop, right? Whether businesses are large or small or moderately expensive or cheap. Because I think the overall cycle that India is finding itself in is actually very good. So to that extent, if you're not too worried about the next couple of months or the next 6 months,
you can look through that.
You're actually buying a very good cycle. As I said, cycles have got extended, and the big cycle in India, I think, is at the bottom or past the bottom. It's not that it's just that it won't come back very rapidly. In that context, I think it's a very good time actually to buy. You just need to have the patience, not get caught up with all that goes up and down. And I think the one big thing that you need to keep in mind is that even this cycle, to some extent, has been given a push by the stimulus that you've got both on the monetary side and on the fiscal side. We were expecting this to come post the elections. It's come before the election, and I think that's a great thing, because whoever comes into power, I think that's something that's not going to be pulled back.
All right. Well, we hope for the best. Thank you very much, Aditya, for joining in. You have a great weekend, and we hope to catch up with you again soon. On that note, we will take a very quick break. On the other side, we talk technicals with Ashwini Gujral. As we take the break, we'll leave you with some more fundamental opinion that we picked up during the course of the week.
Well, what I've seen in last 1.5 to 2 years while managing mutual fund is that when the domestic money comes, it comes in very distributed mid-cap, small-cap funds and a lot of PMSs, small PMSs. And that money actually chases a lot of mid and small-cap companies. The running theme all across is buy growth at reasonable price. We say quality and growth at reasonable price, which becomes even more difficult to find.
I think the monetary conditions in general are better today than a few months back. But clearly, there is a set of NBFC and housing finance companies where liquidity is a bit tight. Even the good NBFCs have either slowed down growth or taken a bit of hit on their NIM because of higher cost of funds.
It may be a period of time before we know whether this does escalate or whether you have this strike and there's no response from the Pakistanis of significance in terms of adding to the geopolitical tension. So let's wait and see. But I do go back to, we've had incidents in the past and their impact on the market has been pretty modest on a medium-term view. And that's why I think international investors tend to look.
Welcome back. You're with us on Taking Stock, and joining now is Ashwini Gujral to talk technicals and look at the trade setup for the next week. Ashwini, Friday was a very strong close for the market. How do you sort of, parse through some of the developments? The mid-cap space is so attractive. The small-cap space is also bouncing back. Your assessment for the week?
Well, this week something has changed, which means that earlier on a weekly chart, the 20-week moving average was going in between the price. This week, the market for the last 7-8 weeks was trying to rally 10,600, 11,000 thereabouts. This week it came almost to say 10,700 and failed to get below the 10,700 mark, despite all kinds of war rumors and all kinds of negativity. So that way, while earlier the range was 10,000 to 11,000, this time, for the first time in many weeks, we have failed to break the 10,550, 600 zone. Now, what this means is that support is coming in much earlier than much earlier than before, and the way the markets are acting, the mid caps and everything is happening a bit earlier. It shows that possibly the next week should also be higher, and the market may just surprise people by going up. So that way, a 20 DMA halt is happening, and I wouldn't be surprised if 11,000, 11,050 also comes in during the week. So somewhere, the banks are rallying, the mid caps are rallying, the small caps are rallying, Nifty is going up. So that way, everything is now beginning to pick up. So my sense is that even with a curtailed week, you could have fairly strong days on the upside.
Ashwini, in terms of actual trades you'd want to put on, what would you do?
If you see the way PSU banks are moving, I think there is a fresh move afoot out there. So Bank of Baroda is a buy with a stop of 104, target of 116. Canara Bank is a buy with a stop of 240, target of 254. And PNB is a buy with a stop of 74, target of 82. If these minority shareholders don't need to be given some sort of open offer, I think that will be a positive, and that will ease out certain things. So my sense is that a 10 to 15% rally on these smaller PSU banks, the corporate ones, it's likely.
Okay, so 3 PSU banks is what Ashwini is asking you to buy for trading as far as the coming week is concerned. Well, it's a wrap here of this edition of Taking Stock from Surabhi. Me, everyone on the team, thank you very much for watching. More coming up on the other side. We'll see you back Monday morning.